Welcome back, everyone. Blueprint for Closers podcast. My name is Dominic Ciccarelli. I'm here with my co-host, Robert Nixon. Welcome to episode 8. We're here with none other John Tapinis from About Profit. John is my personal accountant, but a nationwide accounting firm, although he still keeps it the feel of a boutique firm here in New York City. John, thanks so much for coming on and being with us today.
Thank you, guys.
So, John, I've been working with you for over 10 years, and not only as my accountant, but you and I have been friends. We have a lot of mutual friends. Why don't we start off by just telling the group a little bit about yourself and how you became an accountant and a little bit about your background?
Yeah. So, look, growing up, I don't think anybody says and they're 8 years old, I want to become an accountant, right? So that really wasn't the plan. But I remember my parents, I was real young. There was a knock at the door. My mom went to the door, and there was this guy that she was frightened of, and it was kind of odd. I didn't understand it. And what had happened was that it was the IRS. They froze my parents' accounts because there was a miscalculation on a tax return that someone did. And they had to come up with like $7,000. Now, back in the 70s, the blue-collar workers has a lot of money. My parents were very upset, and I kind of felt powerless. So I'm like, I want to do something to help people to make sure that doesn't happen again. And that kind of led me down that path of accounting. And what really helped with that was knowing in my mind, I enjoy logic, math. I'm definitely right brain sided, so it helped towards that, and I was able to do that through accounting.
It's amazing how like little things that happen to us when we're little just stick with us forever.
Crazy.
I had a cousin who lived out in Long Island in the Hamptons actually, and same thing, blue collar background. My summer vacations was visiting my cousin out in Long Island for 2 weeks. And he was a builder with an architectural background, and he had a really good life, right? He had a boat, and he was on the beach, and he was in this beautiful place. And 30 years later, I happen to go to school for architecture just like him, and I'm in the construction and real estate world. So it's your experience as a kid really echo as an adult, and as a parent now, I'm super conscious about like my kids, like what the things I do, how it affects them. So that's interesting.
Agreed.
So from going to school to be an accountant, I presume you didn't want to work for someone. I know you work for some big companies,
right?
And then something happened where you wanted to be, your own guy.
So in college, I used to work in garages in Manhattan, and I was a doorman at night, like in between. So in the summers, I really worked, and what I found was that I really got along with the people in those garages who were creative entrepreneurs. They own their own businesses. It was just so much fun talking with them. And I'm like, I love the way that is. And how do I get in touch and be involved with them? Working fast forward, in college, I went for architecture in the beginning. Didn't really pan out. Yeah, I was an architect major. Really, really enjoyed it. Frank Lloyd Wright, been to his places. It's really fantastic. See things a little bit differently than others in general. But as I went through and I worked at Ernst & Young, I came out on my own. I was able to now work with these really amazing people who need help in a way that they're not used to, right? So most people are left brain creative, and they're just thinking, how can I create this stuff? And they don't think of the other side. And I'm able to hopefully I bridge that gap between the two sides of the brain.
Connect the two.
Yeah.
Tell us about Profit, and tell us about the firm, where you guys are located. Your perfect client, type of clients you represent, and what your plans are for the future of the firm.
Our firm, we have, who has offices anymore, right? But we do have offices, New York City, Staten Island, New Jersey, and California, right? And a lot of our clients are in California and New York. That's, if we put a pin up of a map, we put pins in there. East and West Coast are really where we are. We work a lot with creative people, a lot with entrepreneurs, and a lot with business owners. And the reason why is not because I don't think I can do a 1040 or help someone out with a W-2, but I can't bring as much value or help people. So What I find is that business owners really appreciate, as they find out throughout their owning a business, that yes, you can work hard and get the sales and do whatever it is, but you turn around, you have to pay all this money in tax. So either you don't have it, or you don't want to pay it, which is kind of both for most people. So in our world is that we know that we can help you not pay as much tax, and we can make sure that you have the money to pay what you do owe.
Yeah.
So we kind of work in that world.
Any business owner, and I when I first started the firm, I had a one-man shop accountant, worked out of his house, and for that time it worked for me. But very shortly after that, I realized that I needed someone much more sophisticated for the things I was getting involved in. And that's how we met. And I mean, my knowledge in the tax world grew tremendously just seeing how John operates and how he kind of maneuvers around. And there are so many tax benefits. I mean, most of the richest people in the world became that way because they knew tax law and they knew how to navigate certain things. You know, everybody wants to make fun of, I guess, Donald Trump for saying, oh, he never pays his taxes and things like that. And regardless of what political side you're on, the truth is, you know, you work hard for your money and you want to keep as much of it in your pocket as possible the legal way. And if there's law that allows you to do certain things, right, you should take advantage of it. And if you have an accountant that's not helping you do that, then you probably have the wrong accountant. So obviously we're focused on real estate, you know, building the right team to build a real estate portfolio. I believe, and Rob believes, accounting is a huge part of it, right? For the new investor, the new guy coming into the game, buys his first 2-family house, what would you say are like the top 3 or 4 or 5 tips that you can give to that person? For example, should they buy that home in their personal name? Things like that. Like what would you tell if someone walked into your office?
Right. So new investors are really their own animal because they usually don't have enough capital. They try to get in, they want to get in, they watch all these TikToks and YouTube videos, and you can do it yourself, do everything yourself, and they kind of want to do everything themselves, and they want to get into it. And I think that's great because you want to move on. But they're getting misinformed, right? So yes, we can do all these really complex things that help you move to the right direction, but it makes it very complex, and there's a lot of fees involved with complexity. So people don't really understand that. What I normally tell people is that if you have something to lose, put stuff in LLCs. So if you don't have anything, you're living in your parents' house, and you go out and buy a 1-family, there's nothing for you to get. Buy your own name if you can. Make sure you're insured enough to be there, and then rent it out. Right. Eventually, you want to get it to an LLC. That's absolutely the first thing we do with people is put things in LLCs. We never advise people not to. But if you can't afford it because you think that there's other steps, because what happens when you put in an LLC, it becomes a business. When it becomes a business, interest rates are higher, insurance is higher, everything's higher. So we try to make sure that people understand that because they're only looking at costs when they do the deal as if they're doing it themselves instead of having all these ancillary fees. But yes, it absolutely should be an LLC.
Right. Now, when you go for a mortgage, like you said, can you have it in an LLC but still apply for the mortgage personally?
So you're always guaranteeing a mortgage personally, right? Yep. So that's definitely. So what people think is that, LLC will take the mortgage. Yes, but you're going to be paying for it at the end of the day. It's not going to be anybody else. And the rates will be a little bit higher. So people try to, I'll get the mortgage on my own personal name, then put the deed of the house in the LLC. Well, that's great until someone looks. And then if they do look, you'll get a knock at the door. Hey, give me here's a default letter.
Right, and they call back the note.
They call back the note.
Yeah, be careful with that. Even we had this conversation in a previous episode about calling in notes. I mean, if you don't read the fine print in any of these agreements that you're signing on the mortgages, I mean, more and more banks are going to be calling back notes because you have a marijuana dispensary or your 5-year mortgage is up. It's time to refinance.
Or you put something from your personal into an LLC and you had no business doing that.
Right.
That's right. Okay, cool. Talk to us about depreciation, and then to be a little bit more elaborate, maybe cost segregation, right? I know this isn't the most exciting topic, but if you're in the game...
What do you mean not exciting? I think it's fantastic. It's one of the best things in accounting, depreciation. Don't forget amortization. No, but all kidding aside, what is depreciation? It's pretty simple. IRS normally gives you the ability to write things off. Like if you buy a copy machine, that's a direct write-off. You buy a computer, direct write-off. When you buy something that has size to it in a dollar amount, like a home, the IRS says, oh, you used to be able to write it off in one shot. And the IRS said, hold on a second. Real estate's different. We're going to take it over a certain amount of time. Personal residence is about 27.5 years. Commercials, 40 years. So there are ways, that's depreciation. So you buy something for make it easy on the numbers, $2.7 million. You're going to get a write-off of $100,000 a year for 27.5 years, which is great because then you can
make $100,000 without paying tax
on it. So it really works out in that benefit. Now there's pluses and minuses with everything. When you go to sell that property in 10 years and you've took $1 million in depreciation already, and you say, oh look, you know what, I'm selling it for $2.7 million. No, you had a loss of $1 million. So now you made a profit of $1 million. So people kind of don't understand that, but
Right.
that's really what happens.
Right.
And I think that's where having a great accountant is so critical, right? So I was fortunate to get involved with John from a young age. Had some great mentors. I wouldn't have really known from the beginning. I would have just assumed that even as a realtor, for example, I speak to people constantly, and I've referred tons of friends over time that put their businesses into LLCs or S corps, and it's just there's so many things that have to be methodically done. And John, fortunately, takes my calls all the time for.
If I don't, he shows up at the house.
Yeah.
That's what happens.
So if you're going for going for mortgages, there's so many different things you have to do. Any kind of purchase, you have to take into account, oh, hey, can I write this off? I mean, if a car is over a certain weight, you could write the entire thing off, whatever
Right.
it may be. I mean, there's just so many benefits that you could be using, and I think it's just a shame that people don't. And
Right.
with a real estate perspective, I mean, there's countless things, obviously, from a protection standpoint, but then also one thing that I don't think people give a lot of credit to is, for example, participating in a syndication deal. Granted, you get that interest that whatever that equates to on a return on your money, but with that you also get that depreciation. You hit it on the head that now you get to write off
Yeah.
against. Now that's something I really hadn't even really understood until maybe the past couple of years, and it's just it could be
It multiplies it tremendously.
absolutely.
Yeah, yeah. Speaking of depreciation, I mean, there's another term out there called cost segregation,
Right.
which is really expediting depreciation a little bit faster, right?
So with the CARES Act that came into play when COVID came in, they allowed people in real estate to accelerate depreciate, or not in real estate, just anywhere. Hey, if you're buying a car, you can accelerate. You're buying equipment, you can accelerate it. They wanted to spark economy, right? So if you want to see what the government wants you to spend money on, they give you credit for it. What do they want you to buy? Electric cars. They want you to buy equipment. They want you to go out and have meals, because
Solar
meals
panels.
are 100%. What?
Solar panels.
Solar panels as well, right? So
Yeah.
you're getting these tremendous credits. That's how they want you to move forward. But what I'll say is that the cost segregation was a great model where you're able to say, hey, look, inside this house, it's not just a house, because a house is a house, right? 27 and a half years. We talked about it
Mhm.
just 2 minutes ago, saying, hey, we can buy a house and depreciate over 27 and a half years. They take that house and they look at every piece of that house. Okay, this plumbing, this electric, the alarm system, the doors, all these things are separate. The kitchen cabinets, and what they do is they take it and they put it into these other categories, which are these 5 and 15-year categories that you're able to super depreciate immediately. Now, IRS is great. They're the biggest tax burden that you have, and they're the ones who give you the deduction. But states don't allow it. They're like, hey, listen, we're decoupling. We don't want to deal with that. We're good. You're going to pay on that, and we'll take regular depreciation for you. But federal gives you that right off right away.
So who and how does that help, right? So I was in a position where I was selling something that I didn't have the ability to 1031, right? So I had a really significant tax burden. Fortunately, I was getting into an asset that I was able to cost seg, which really helped my
Offset.
tax significantly offset. Now, somebody who's not in a position of a sale, right? Because I'm actually not really sure. How does that help somebody? Like if I own a 10-family building, right?
So
Does cost seg help me maybe?
Yeah, I just had somebody. He has 4 multifamily units in Brooklyn, right?
Okay.
Him and I have been talking for years. Had a conversation with him. Look, you should do a cost seg. Your buildings are worth a bunch of money, and I think that would be super beneficial to you. And he's like, why? What is the money going to do? Sit in the bank? I said, well, it could sit in the bank. You can do another deal. Whatever you want to do, let's just take a look at it. We explored that possibility, worked with a cost seg expert, and it wound up that he was getting, instead of having him pay $400,000 in tax, he's actually getting back $100,000. So it was a tremendous difference for him. And he's like, time value of money. I'm getting that money. Now, listen, you don't get that right off later on. So you're going to have to pay a little bit more as it goes on, but you have that money today, which is important. Having
Right.
money in it. In
So
your
you would,
pocket
to
today.
answer Rob's question, you would say that the only time it makes sense to do a cost seg is to offset a tax liability.
No, not necessarily. So there's multiple ways. So how I start off every conversation with any new client or any client that I have is, what's your goal? And I will say 99.99% of the time, people say, I want to save taxes. Like, I want to pay the least amount of taxes. And I agree. But sometimes that might not be the best way to do it, because if you're going for a loan, if there's other avenues, if you're looking to franchise your business, you don't want to have that least amount of tax. I don't want to pay the least amount of tax. I want to write off everything. because that doesn't look good. You're trying to accomplish something else.
Right.
But the reality is that if you have something, you can not only have it for this year, but it also carries forward. It doesn't stop. So if I say, hey, let's do this cost seg, you don't really pay taxes this year as much, or you're not able to use it. You're able to use it in future years. So
Right.
it doesn't go away.
So
How does that work? So
It carries forward.
Really?
so it's a line item on your tax return that you have this credit.
Correct.
For how long?
Until you use it.
That's interesting.
Yeah.
That's really interesting.
And when you cost seg and expedite the depreciation, is there a cap 10 years? I believe. How much can you expedite?
No, it's
Or push off.
Yeah. When you do the cost seg, you do how many years, or is it you take the
no.
whole
So
asset?
so what happens is you take the whole asset.
Okay.
So you take the whole asset. Let's say the asset's $6 million. Normally it's about 20% write off. So that's 1.2 million. So you're able to take a $1.2 million write off immediately. Now, for most in real estate, that's a no brainer because in real estate, you're both real estate professionals. You're able to apply these rules directly to other income that you have.
Right.
Outside of that, the majority of people aren't real estate professionals. Once you make over $150,000, you can't take a write-off go past zero. But it's still good to have, and just to have it there for you.
Yeah.
Another great question, right? So, client the other day said, "Yeah, I'm really changing things in my personal life, and I'm actually changing my tax status to real estate professional." Okay, what does that make a difference to somebody?
Yeah, that's a good point. So you can't really just change your status to professionally by checking a box. There are rules, like you have to work 700 hours, has to be more than another job you have. There are certain rules to do it. But what's great about it is that you can write off all of these losses against other income. So if, let's say I'm a real estate professional and my wife is a nurse and she's working, she makes a couple $100,000 a year. And I'm a real estate professional. I work 700 hours. I meet all the criteria. I have a $200,000 loss. Guess what? That goes against her income. So whatever she paid in, we get back. Our income goes down to zero.
So to give you another scenario, let's just say your wife didn't work. You worked as a lawyer. And you did acquire all of this real estate. And your wife is on the real estate with you. You could give your wife the job now instead of having no job. Your job now is to manage all of our real estate. You teach her the business. She actually does it, right? She collects the rent. She pays the bills. She takes the calls from the tenants.
She has to actually do it right.
Right. She's managing.
Keep a log. People keep logs.
Yeah. So she's managing the real estate on behalf of the family. Now she qualifies as a real estate professional, and that's an additional tax benefit.
Correct. It's the same as being a real estate professional for you or for her.
Right. But if she did nothing and you managed all that real estate on top of being the lawyer, you wouldn't get that benefit.
You wouldn't get it.
So it's a huge thing,
It's huge.
A lot of guys that own and manage real estate have a regular 9-to-5 and they can't take advantage of that tax credit. So maybe you have an adult child that's not working. You have them take that role of managing the real estate. Now they're considered a real estate professional.
Right, but they have to own the real estate to get that benefit.
Right, they have to be part of the asset.
Right.
Interesting.
Which most people are. As they get older, I see people divest to their children.
Yeah.
Right, because they want to help them and move them to the right direction.
So your shop is totally different than others from what I've heard from countless people I've spoken to, right? So this past couple of years, in addition to, of course, just doing standard returns and so on and so forth, you do a lot of planning, right? But then there's also, I know you've assisted, you've certainly helped me and assist me in grants and PPP and EIDL and all that. Like, how's that tied into your business? And
Look, when COVID came in, it changed a lot, and it changed not only the dynamic of how we work and what we do, but it also changed the dynamic of all these new grants that were coming out. So every day I would get phone calls, emails, texts from various clients saying, "Hey, there's these grants. Can you help me out? What can you do?" So instead of saying, "Hey, listen, that's not what we do. Let's do this," and I know people are hurting because all of a sudden business stopped. We made it a point to help people out as much as they can. So we went in and looked at all of these grants. Now, some of these grants were they weren't even enough to do anything with at this point because they just said it on CNBC. There was nothing else. They said on Fox News. There's nothing anywhere yet. There's not even written up. But we went in, did the education, talked to the state, talked to the IRS, and made sure that we knew the rules, and then we were able to help people out, which really made a big difference for a lot of people. It got them through that crisis.
So let's just break it down per topic. Talk about PPP. What is PPP? Why was it created, and how did it benefit people?
Right. Good question. So PPP was a loan, right? At first, it was going to be a loan to say, "Hey, look, I know you can't have anybody working."
What does PPP stand for? Payroll
Protection Act. It's a Payroll
Right.
Protection Act.
Right.
So they were trying to what it was is to help businesses keep employees. So if you keep your employees
during COVID.
during COVID, we'll pay you to do that.
Right. So
And-
it's a bonus for not laying people off.
Right. And that's what happened. So at first, and the rules kept changing. So the first rule was, hey, you can do that. And then then you would have to pay tax on it. Then they said, okay, you don't have to pay tax on it. And then they said, not only do you have to pay tax, you don't have to pay it back anymore. So it went through all of these
It's called the Payroll
iterations.
Protection Program.
Right, Payroll Protection Program. So it was really interesting to kind of see how that all laid out. And then what happened was all these other grants were working off of this PPP grant. So this PPP grant was saying, hey, we're going to give you money. But then New York State came out with a grant. New York City came out with a grant. New Jersey came out with a grant. IRS came out with an additional grant, which was the ERC. They all said, hey, if you got the PPP, you don't get any of us. So people are like, okay, I take the bigger one, which PPP was pretty big. And then I guess with pressure from constituents, they said, okay, listen, if you do get it, we're going to give it to you, because they couldn't give out money.
Right.
They had all this money in the hopper, in a hopper, and they couldn't give it out
Right.
because everybody got the PPP. So that was the next step.
So then what is the ERC tax credit?
ERC is the employee retention credit, meaning that if you had people, so COVID hit, you look at 19. 19 was the year that everybody looked at. When you look at 19 and you went to 20, if you were 20% down in revenue, you were able to get the ERC, which is you got back a portion of the Medicaid and Social Security back on people's money. So people were getting a lot of money back. But again, at first, it wasn't really a good program, because if you got the PPP, you couldn't get it.
Right.
Majority of people got that. Then they changed it. Then it went to, hey, look at what's going on. We can get it for you. Then the rule changed to say, okay, instead of doing it very, very, 20%, it's 20% now, 50% here. And then they changed it even more, saying, hey, if your people went down by 10%, we'll give it to you. If the time of those people went down 20%, 10%, we'll give it to you. And if you get it for one quarter, you qualify for another quarter. So all these rules are coming into play. We're able to help out a lot. But with all of that and the filing of it comes all this corruption. My gosh.
Well, that's what I was going to bring up. You hear people now going to jail or getting in trouble because they spent PPP and RC credit money. And I'm like, well, they got it in the form of credit back into their company, right?
Right. So the people, a lot of people went to jail. They were fraudulent with how they got the PPP. They shouldn't have gotten it, and they did
so
get
it was the documents they created in order to qualify for PPP, not
Correct.
the money they got when they got. Okay,
Right.
it's
Well,
not how
the money,
they spent it once
well,
they got
the money
it.
they got, that side was the EIDL. That's that loan that everybody was looking to get. So the economic development.
Right.
whatever
Okay.
loan. So what happened was people were getting these $2 million loans, going out and buying Ferraris, Bentleys, condos, and not spending it in their company, and they didn't need it. So those people, they were flashy. They got caught. But what's happening now with the ERC is that even I'm getting calls. Hey, you want to do ERC for your company? I'm like, well, I appreciate it, thanks, but no thanks. I have people calling me up that I know didn't qualify. I work with them. I said to you, you didn't qualify based on the rules. I know what they are. You don't qualify. This person's saying I qualify. Well, because they're getting paid to do it, and it's pretty easy.
Right.
So,
And then when you get audited and you have to pay the money back.
well, so they did a couple of things. One, they extended the audit period for 10 years. Instead of doing it for 3, 10.
Cool.
1, 2. They just stopped taking today. Right before I got in here, I got a
Applications
alert.
for ERC.
No more applications for ERC.
Wow.
Suspended to the end of the year
Because of the corruption.
because of the fraud.
Unbelievable.
So I have two questions that just came to mind that I think people would find very interesting. So as a person, as an LLC, as a multi-member LLC, as a corp, what is audit risk versus, each of them roughly?
Yeah. What sparks the audit?
Yeah.
Or no,
So
what's the difference? How much?
yeah. So back in 2002 or 3, I had an auditor come to the office, sitting there for about a week. I've never had an auditor in my office for a week.
Is it for you or for a client?
It's for a client. And I started talking with him, very nice guy. And he's like, we're coming up with ways to audit people. And he goes, this is one of the clients that it is. She had no change, so we were good because her numbers looked a little skewed, but the way her situation was, it was correct. But he's like, we're trying to figure out, instead of throwing out a net and just trying to catch fish, we're trying to use a laser and just zap what we know. So they've been doing this for a long time. Now it's gotten even better. They have better technology. They understand it. They're putting money into it, so they want to audit. So what I'll say is, from my experience, what I've seen is that anything Schedule C, sole proprietorship, the easiest thing people file. the thing takes no paperwork. You just open a business and do something. You're a Schedule C. That gets audited a lot because you don't need financials. Right? You don't need someone to help you to do things. So you might not know the rules. You're doing it yourself, and then if you don't do it correctly, they get that money. It's a pretty easy way for them to do it.
And this is why the government hired 10,000 IRS agents this past year?
They didn't hire them. They didn't want to hire them.
Oh, right.
They were going to try to hire them, but they didn't want to hire them. That's a whole nother thing. But they didn't hire them because they went out. Their ad was, okay, we're going to pay you X amount of dollars, but you have to work 60 hours a week. You have to have a cell phone, be on call 6 days a week, and you have to carry a gun without a felon. Who's sitting around getting that stuff that has all those criteria? I don't know, but I can't find people to do work.
Right.
They're much lower, and I don't think they could find people. So that didn't work, and that's been a struggle for them. But what they are doing is they're looking at overall percentages. Hey, what are you doing? How much money are you making? Where is it looking at? So you can see it.
They probably have like a list of every profession. Okay, architect, he or she should be making 30% on their income, or an accountant should be this. And then if they see it's much exaggerated, okay, we have to see what this guy's doing.
Right. I haven't seen that specifically, but I think that's where it's going towards.
Yeah.
It's going to happen.
They're creating standards in the business on where the profit margins are.
Yeah, they're getting more and more. And look, the IRS really wants
artificial intelligence is just going to
insane.
So is auditing higher now? Are you seeing a lot more auditing?
Not yet.
Okay.
No, and by the way, most accountants like audits.
Yeah.
Because it's revenue.
Right.
You get audited. I have to represent you. You're going to get represented by somebody. You're able to help out and do that. I don't find value in most of that. I only find value in when it's someone that's not my client that comes in, and I work with that constantly. But the audits haven't been as much at all.
What do you find when you take over accounting from, let's just say, another accountant to you? You know, people switching over. The biggest mistakes accountants are making with respect to protecting their clients. You know, what are some of the layup write-offs that people could have took that didn't take, like the common mistakes? That's
a good question. So what happens is that when I get into a client, I look at them with fresh eyes. If you've been with your accountant for 10 years and they're not talking to you, they're just taking what
robots.
You get, they're doing whatever it is.
100%.
So there are
they
things. They can't
see the forest through the woods.
Right. Because they're so busy that they're doing tax returns all day, that they're so busy. That's all they want to do. That's all they're doing. They're not looking to save them because they're not able to monetize that.
Right.
So at the end of the day, what we do is we sit down and we look at your information. We we understand what your goals are, and then from there we can see and say, oh, by the way, you have family, you have kids. They're on the website. They're doing work for you in the office. You're able to move. You're able to pay them and actually take money off of your own tax return. Your whole family is on the board of your corporation, and you're going on a trip to California to go to whatever you do. Hey, that's actually a write-off. It's not necessarily a vacation. It's a write-off.
Right.
It depends how many days. Of course, there's other rules, but certainly
right.
Those are the things
highbrow,
that you can think of.
That you could take advantage of things like that.
Yeah.
Car payments, depending on the business you're in, things like
right.
that.
You know, it's funny. As I was working in garages, the guys who had the nicest cars were self-employed. And I think still to this day, the guys who have the nicest cars are self-employed.
Right.
Well,
and there's a reason for that.
Well, so I know two people that got Ferraris recently, right? And I went to three actually, and I went to the first one. I said, "How do you buy a Ferrari?" By the way, he goes, "How do you not buy a Ferrari?" He goes, "They got the biggest scheme going. They'll set up the entity for you. They'll lease it to you through your entity. They'll set it up in a different state. It doesn't come up on your credit. This and that." Is that true? Balloon financing, all this stuff.
Right. Ferrari has their own way of financing things, right? So I've seen that in those terms where they do, I think, one credit check, they finance it. The other state stuff is a little bit different where people try to, hey, if I buy it in Montana and LLC, I don't have to pay the sales tax on it. But it's, I tell people, look, if you want to be egregious, you get caught. Right. And to do that, if your car is sitting in your garage in the state of New York and you're saying that you have it in Montana, doesn't make sense. So that you wound up getting hit on that stuff.
Yeah. Well, the insurance company's asking you where it's being stored, so it's easy to figure out.
So I see people trying to hide them from their wives.
Yeah. So during COVID, we saw a mass exodus out of New York City. A lot of people went down to Florida. People even went down to Puerto Rico. And big tax breaks, which we all know exist. But I don't know if I'm ready to pick up and move to Puerto Rico just to get a tax break. what are some other ways to do this? I'm hearing now move a lot of your assets into trust, these very elaborate things, which are expensive to do, but maybe not as expensive to buy as buying a house in Puerto Rico and flying back to Puerto Rico to spend 6 months there.
Yeah. So what happens is I see a lot of these things. Hey, put all your assets in trust. Don't pay any tax. I don't really know and understand how that absolutely works. I mean, I worked in the high net worth individuals at Ernst & Young in their trust and State Department as well. I've been doing this for 20 plus years. It's to put all that stuff in trust, and I've worked with very, very affluent people. That just doesn't exist. It's kind of funny how they say, they mix words around, they kind of say things, but it doesn't really work that way. Trusts are great for a lot of reasons. Makes it complex though, and it costs fees. So if you don't have that ability to do that, like buying a jet, hey, you buy a jet, you can write it off. You buying a jet?
No.
All right. So are you spending $60,000-$70,000 a year to have your taxes done so you can save some money?
Right.
I'd rather pay the state taxes than have that complex done.
Right.
So there's back and forth with it. And what I'll say is not all people can move to Florida and save the tax on the state.
Right.
Because you have a business in the state, whether it's a piece of real estate that you have to pay tax on here, or a restaurant, or some other type of business that has nexus. That's
hard.
what happens.
I mean, listen, even if I decided to pick up and say I'm going to spend half my time in Miami, I still have 2 young kids in the public school system here in New York. The moment they're in public schools, I disqualify. It doesn't matter if I spend 10 months a year and live in Miami. They're in the public school system, right?
No, I have people that are separate like that.
Okay.
But it's whatever your intent is. If your intent is not to be with your wife and then to be away and there's a reason for it, I've seen that. But you're right. It leans more towards having kids and a wife in a different state.
Yeah.
That your intent is to come back.
This all comes down to what you said before, just being egregious.
Yeah, people are crazy.
I mean, within reason, there's systems in place for a reason.
You're in New York City for a reason. You're in New York City to get the income. You're in New York City to be in New York City. You love the architecture. You love the art. You love museums. But listen,
Love
price.
the homeless.
The price to do that, the migrants, moving the migrants into my extra bedroom.
And you'll smell marijuana everywhere you go. It's great, yeah.
Very interesting. Very interesting. I'm sure you have some wild tax stories. Tell us an unexpected tax story that happened that stands out in your mind.
I would say 2 stand out, right? So one, I just went on my own, get a new client, comes in, he's getting audited. So I said, sure, I'd be more than happy to help you. It was a sales tax audit. And he said that his store made like less than $0. He made no money at all. For years, you look at his returns. It was a deli.
Okay.
Yeah. So for years, you look at the store, and it had no profit. It had very low gross, no profit. The order comes to the office. We're sitting there waiting, and at that point, I had storefront, so I had windows in the front. The gentleman pulls up in a brand new $100,000 Mercedes-Benz, comes out, walks in, and the order's like, "Are you kidding me?" And I'm like, "What are you doing?" Like, and by the way, I don't like people coming to audits. There's no reason for you to be in an audit, but he wanted to be there, and he got what he wished. When he got in, that order basically shut down and walked out. And
Unbelievable.
Said, you have no, it's my uncle's car. He said, "My uncle's car, your uncle's car."
How about some of the what's the most ridiculous questions? Like somebody's called you like a purchase or.
I'm sure like you
and
guys.
Don't use any of my questions as a reference, please.
Because I mean, mine is definitely something that like.
So I guess where that comes from is I feel like, and I'm sure you guys feel the same way. You're like a shrink sometimes, where people start talking to you about their whole life, and I'm like, you're cheating on your wife, and that is something to do with what? I don't understand.
Clubs, what? Not write-offs anymore.
but like another crazy story, like it just happened recently. Somebody comes in, I take a look at the returns. I know they're not right. I could just tell you they're not right. My gut tells me they're not right. They asked me to redo them, and the investment. There was a liquidation of an asset, multiple assets, and that sale created gain. That gain, I was able to reduce by over $1.3 million because the gentleman did it wrong. He just completely did it wrong. And you see this, you're like, how does someone in profession do this? But it happens, and luckily they were able to realize that, hey, look, something's not right. Let's take a look at it. And it was that much. So to go in and go deep. So
on that one, they got 1.3 million back.
No, they reduced their gain by 1.3. So all of their investors, they had investors. All those investors was half of what they had to pay.
Wow,
less than half. So they were very happy.
What about just general advice that you have to business owners? Whether it be IRAs or just in general.
So
aside
I see
from hiring you,
right. I see people that really are good with numbers. do well. Meaning that if you keep track of your numbers, if you think that, if you're going to work out of your bank account and say, okay, I have 50 grand in the bank, I'm good today, but you just paid a $25,000 Amex and you have car payments and everything else coming out and you not really have 50,000, it's very difficult to work. I find that people who have Excel spreadsheets or keep track of things, they do a lot better overall. Also, what I would say is once you get to a certain point, you need to come to somebody that knows what they're doing. Yeah. If you're making $50,000 or $40,000 a year, not say that's peanuts, but certainly the cost of getting a little bit more complex to save taxes isn't worth it. But once you hit that $100,000 range and beyond, you really need to speak to somebody. It's not enough to watch YouTube and to say, I'm going to do this. There are ways to help people move in that right direction.
Especially as you start owning a lot of real estate.
Especially if you own a lot of real estate, or if you have a business that's super successful. There's just ways to work with the tax code and move through that system to get you the best rate. So you're still picking up the income. So $100,000 of income through a corp versus $100,000 comes through a Schedule C or a self-employed is two very different things. You're talking about $15,000 more in one than the other. The corp is better, but corp also costs more money to do. And you have other requirements.
You don't want to wait until after the year is over to then submit all your documents to your accountant to say, hey, you have a tax problem. So at least for John and I, we meet on a quarterly basis. So listen, January 1, we're already planning for the end of the year, So at the end of each quarter, we meet like, okay, this building's performing this way, this building's performing this way, and we can plan for a tax problem, way in advance to
maybe
the year ending.
Consider a cost seg, whatever it is, right? 100%.
Exactly, because it takes time to put actions in place once you decide to do it.
So a lot of these accountants, like I mentioned earlier, they're historic. Everything's historic. Nobody's looking forward in those type of situations. So you're right. Looking forward means a big part. And not only looking forward, understanding what you're looking to do going forward.
Right.
So it's not enough to say, okay, we'll do a cost seg, but you're selling the property next year. You just,
That's right.
It just doesn't make any sense.
Yeah, before I even think about buying or selling a property, I think how's this going to affect me on a global scale of my taxes.
Right.
It might not make sense to sell a building this year, and I could benefit X amount of dollars by just waiting a few months and selling it the following year. So tax planning is huge, especially as laws change. I mean, we had a couple of tax code changes over the last couple of years with the presidencies.
Yeah, with the two presidents, two administrations ago, that there was a significant tax change which benefited a lot of corporations and businesses and really didn't benefit the W-2 family.
Right.
That really put the screws on them and made them pay a bit more tax.
Yeah.
I'm starting to put together now a really common trend here of just a very, I really pride myself in taking a very holistic approach with my clients, sitting down, and it's not just a quick deal. Nobody gets rich on one deal. What are your long-term goals? Where are you looking to be? That's how you can make the right kind of decisions. And I could really attest to the fact that you've always done that with everything. I mean, we've had, and to your credit, as far as personal service, I'm shocked, especially with some of the creative stuff that I've tried to pull or continue to pull, and you somehow remember all of them. So I think it's
because you're so creative. I mean, Jesus, I love it. Who could think of these things?
So I think that's when you're looking to build a real estate portfolio and you're looking to build businesses, you really need that right team. And I think the accounting is just an absolutely critical part of that.
It's definitely part of the team. There's no doubt about it.
What's your plan for the next 5 years with your firm? What are you looking to achieve?
So, great question. The next 5 years, looking to really get into a focus of helping more people. So we're hiring more managers, which are great. And what we're hiring towards is not necessarily skill set, right? So you have to know how to do some corporate stuff, individual stuff. Yes. But it's more about you wanting to help somebody. And the firm we have, the people, we just had a question today. So we meet in a huddle, so we're somewhat virtual, and we meet in a huddle, and there's 20 of us. And the question today was, what do you volunteer at? And if I tell you, 98% of my staff volunteer somewhere currently.
Oh, that's great.
So it really tends to understand, okay, I want to help people. And that's really what we're all about. So keeping them happy, making sure they can do that on their own. They fulfill their lives, us fulfill our lives, and help our clients to get to the best spot is basically what we're looking to do. So
adding value.
And
it's all about the customer relationship.
That's it. It's all about relationships.
Yeah.
Enjoy it.
Awesome. It's about profit.
And it's about profit.
Well, listen, most people don't make profit. It's crazy. Entrepreneurs don't make profit because they want to build a business. They have this thing, but you have to sit back and make sure that happens.
Yeah, look at Amazon, right? If you listen to Jeff Bezos, for the first 15 years of his company, I think he made no money, but yet they see the numbers and like, no, I just took all the money, I reinvested it, and
Worked out well for him.
it's unbelievable.
Well, it worked out well for him because he had angel investors that were able to pay him as much as he needed to get to where he needed to be. But most people can't do it.
Yeah.
So I would say 70% of entrepreneurs are really on paycheck to paycheck. And that's crazy because you're in business to feed your family, to make yourself some money, and to move forward
Build
and
wealth.
to help people. But if
Is
you
that
can't
right,
help
70%?
yourself, you can't help yourself. You can't help anybody else.
Well, a financial advisor friend at the time, when we were talking about, and we're going to have him on at some point. I remember we were talking during COVID, and we were talking about really worrying about things that were happening. And he said, listen, I got some really wealthy clients. Most of them have a minimum of 20, 30,000 a month in carry. And most of them only have maybe 6 to 12 months to cover. And I think that's a reality.
Yeah,
Absolutely.
I think that's a lot. I think most people are really truly month to month. It's scary.
Most people are month to month.
It's really scary.
And once the ins stop coming in, that money stops coming in, they're outs. Once that happens more, and it happened during COVID, it happened in the real estate crash. Once that turns around, that's when things start really moving.
Yeah.
Look, there's opportunity anywhere, right? So right now we're having a hard time in New York. I think this was happened in the 70s. If I'm not mistaken, New York City was a crazy place.
Yeah,
People still wanted to be here, right? It took a really courageous leader to come in and change all that,
Yeah.
and he did.
Hopefully there's change in the future.
I agree.
John, thanks for coming in.
Thanks so much.
I
Appreciate it. Appreciate you guys.
Absolutely.
Thanks.
Bye.